Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. And as we shared with you at the Third Lease, two-time Dow Award winner. Andrew, I think this is the first time we've been able to congratulate you in person on the Market Carver. So
Oh, thank
that
you.
will do. Yeah. It was quite the honor. And if you didn't get the chance to be at the Third Lease, that's totally fine. You pay us to look after things, and you certainly don't have to participate, but just know that the CMT Association, which is really what we think of as the premier association group in the U.S. studying technical analysis, each year they award a Dow Award for a paper that is the winner in their research of technical analysis. So they spotlight and award that paper once a year. Andrew won it in 2017 for his paper on volatility, and found out a couple of weeks ago he won it for his recent paper, the 5% Canary. So excellent done.
Thank you.
All right, so going into this week's topics, we've got three things for you. We're going to talk about inflation data, and then we're going to go into a couple of views of commodities, which also tie into the inflation data. So we're going to start off here looking at the CPI releases, which came out last week, and they show a picture that has inflation falling pretty dramatically year over year. And that is, excuse me, but I say falling in terms of its growth rate, not actually going down in value. That would be really nice, at least temporarily here. But the green bar is all items in the CPI, which is, if you're unfamiliar with it, would be easiest way to think of it as a national average of inflation. Everybody watching this has something different of an inflation rate, just depends on what you spend your money on. CPI is thought of to be an average inflation rate. So that has come down now below 5% on the green line. We do have a little bit of a mixed bag though, because if you look at the blue line, it's stuck up above 5% and not coming down quite as dramatically. So that is the CPI. We call it the core CPI or CPI X food and energy. Invariably, when you see the CPI X food and energy, you'll hear the person talk about, well, the person at the Fed, they don't buy food and energy. So this isn't really anybody's inflation rate, but there's a reason for that. And that is because the green line, as you can see over time, is a lot more volatile. When you include the food and energy pieces, that's really what whipsaws and goes up and down really rapidly. And over time, they converge together. The green overshoots to the upside and it overshoots to the downside. And that's what we saw recently. We saw a big, strong surge in oil prices up through last spring with the Russian invasion of Ukraine. And now we're seeing the reverse of that. The collapse in oil prices is really what's driving that. So what does this mean for you watching this? Everybody's watching the Federal Reserve and what their plans are. We don't know yet. There is still a possibility that they could either keep raising rates, or there's somewhat of a small possibility they could take a pause. But this is one of the key factors into that. The biggest reason to not take the pause is that blue line, that core CPI, still not coming down close enough to their goal of 2%, which makes the likelihood that they continue to raise at least one more time the more likely of those two scenarios. So a key piece of these are clearly commodities themselves, which I'll pass over to Andrew to give us an update really on the composite of the various commodities.
Yeah, so this year we've really seen equities begin to improve their trends. We're starting to see the indices are holding up well. Many stocks have started the year well. But what's also begun to rise is also commodity prices. And this is important from an inflation standpoint, as I'm sure you can guess, as the price of commodities are very much going to flow into, as Adam described, the food and energy portion and several other portions of that consumer price index. As Adam described, we have really volatile energy markets. If you may remember in 2020, for a brief period, the price of oil actually went negative, and then it shot up over $100. And so we see energy markets get really, really volatile. And that's part of what really drove the inflation numbers pretty high last year, and then has led to them declining right now. And so when we start looking year to date, because the Fed is so focused on trying to fight inflation, we really want to see what are some of the inputs or the drivers of those key components of the consumer price index, as well as some of the other inflation gauges we're watching. So what's interesting is, well, the market has started to rally really on the idea that the Fed will pause or actually cut interest rates this year due to the softening of that inflation data. What we are seeing is what we could describe as leading is the rise in commodity costs. And that's what this chart here shows is year to date, the changes in the various commodities from orange to sugar, coffee, cocoa, cattle, gold, and then also if we notice gasoline up 20%. Orange juice up 35, gold's up about 9%, corn's about flat, and then you can see the rest, the real driver on the downside, you can see natural gas is has had a considerable decline, at one point down 50% year to date, as natural gas prices have really dropped, and that's what's helped keep those energy costs down and bring down some of that inflation data. But as this data starts to tick higher, and if this trend continues, then as Adam described, we may start seeing a little bit firming up, unfortunately, in some of those key inflation metrics, which I think would maybe have to give the Fed a pause, and not the pause we want, not a pause in interest rate, but a pause in the potential of softening their policies. And possibly maybe they have to hike one more time, maybe 25 basis points again. We're obviously keeping an open mind, but that very much will have equity market and very much so fixed income market implications. So when we look at commodities and talk about commodities, it's not just for commodity's sake, but it's the implication those commodities can have to other parts of the market, fixed income and equities, and how they all are connected. And so they're all kind of talking to each other, and how they impact one another. And so while we're talking kind of on that topic of commodities, one that we often get asked about and something we're often discussing is gold. And gold has started to do pretty well here recently. In fact, gold prices now have risen to the prior 2020 and 2022 highs. We broke above $2,000 an ounce. Gold had a really strong rally off those October lows, and now we're back to these prior highs. And so obviously the question becomes, do we need to start socking away gold? And that's something Adam's going to start discussing. But from our perspective, we think gold can be an attractive asset class. It's not always a great inflation hedge. We can look at just this chart and see that just last year, we saw inflation shoot higher in 2022. And what did gold do? Drop like a big, heavy, shiny rock. And so not always is gold going to be this great inflation hedge. We view it like other asset classes, offering potential return opportunities. And so we are looking to see, is gold prices about to break out and move higher? Or are we going to start seeing these prior highs draw in sellers and seeing gold prices lower? We're keeping an open mind, watching how price moves and reacts, but always keeping an eye on gold, but viewing it not as something overly special, looking at it just like a lot of other asset classes.
Yeah, couldn't agree more, Andrew, and very well said. And we are getting the question more: should we be buying up gold and storing it in the house as a form of safety? And I really like the way Andrew put it, and that's there are cheaper forms of lumbar support before putting gold in your mattress and storing it. And I think that's a very simple yet elegant way of saying it. It's really not the most convenient way to manage wealth. There are logistical challenges with gold. And first, it's just a disclaimer. I'm not going to tell you that it's the worst thing ever if you acquire some gold bars and have it in your safe. Totally a smart and savvy thing to do. But the challenges with that, I think, are important to highlight. It's not logistically the easiest thing to trade. You have to actually get the gold in your vehicle. You have to get it to a place where you can transact it. And you have to usually pay what are pretty hefty transactional fees to actually buy and sell it. So again, if you're buying it and storing it up, and it's just going to be a piece of your overall family plan to have a small piece of your net worth, that's totally fine. But then the last piece I would keep in mind is it's really a difficult thing to deal with on a legacy basis. So much of what we try to do at Financial Enhancement Group is really to help your family plan for a really smooth transition of your assets and make sure that your assets are ultimately taken care of according to your wishes. And the physical storage of gold is just one more hurdle you have to overcome. Now, when we do have gold exposure, we want to acquire that given technology available to us today. Like so many other assets, we can do it in seconds. Inside of exchange traded funds for very, very minimal cost. And unlike other commodity funds, whereas you're trading futures in the ETF or exchange traded fund, in gold, you're buying and you have direct ownership in the underlying gold. So Gold isn't something that we want to just in our portfolios will always hold. As Andrew showed you, there's ups and there's downs, and it doesn't pay us any income stream. So we really want to have conviction in the shiny metal going up if we're going to own it. But when we do, it's not going to be something we hold forever. So we want to be able to get in it. We want to be able to get out of it, and we can do that inside of the account. It's much harder to do. To go to the safe, have you run over to Winchester here if you're East Central Indiana or wherever may be local to you and actually get that transaction done. So if you have remaining questions, by all means, give us a call and we'd be happy to talk to it about this or anything else. As always, 800-928-4001. We do thank you very much for your time on this week's Market Carver and wish you the very best of weekends.